So, let's see. First of all, guys, and now let me make it more full screen mode. Okay, bigger. Anahuac University has owned 80% shares of Anahuac High School Limited since high school's incorporation. Below, there are statements of financial position of Anahuac University and Anahuac High School at December 2021. Prepare consolidated statement of financial position of Anahuac University as of December 31st, 2021. Note, measure NCY, which is non-controlling interest. Okay. At its proportionate share of Anahuac High School net assets. Okay. So guys, the first step is to combine items of assets, liabilities, equity, income, expense, and cash flow of the parent with those of the subsidiary. Okay. Who is the subsidiary?
In the high school?
Yes, it is. So while you do it, I'll give you 5 minutes to do it, guys. To make the first step. Combine like items of assets, liabilities, equity, income, expense, and cash flows of the parent with those of its subsidiaries. So guys, do it by yourself. How would you do it? Who can tell me how we will do that step?
I think we would just like sum the, for example,
That's
property,
it.
plant, equipment, and that,
Yep.
and then at the end sum it all.
Yep.
Like the total.
Like that, just like that. And you have a column in there called step 1. Okay. I just finished and I started as you. Thumbs up for those who finish. Let's see who's the fastest in Excel. Who has finished, guys? Are you done?
Yes.
Awesome. Is everybody done? Perfect. So let's continue, guys. So, what is the second step? The second step is carrying the amount of the parent's investment in the subsidiary, okay, which is this one. And we have to eliminate the parent's portion of equity of each subsidiary. So, and obviously recognize any non-controlling interest and goodwill if there is it. Okay, this is what we have been talking about. Remember that part? So first of all, we have to eliminate, I just gave you a second column, okay, for the eliminations. And obviously, guys, this is like in a trial balance format. What is the component of the trial balance format? That all the accounts from the assets are in its nature. Nature of assets is positive and the nature of liabilities and equity are negatives, okay? So it balances at 0 as any trial balance. Remember that part? So let's start with the eliminations. We have to eliminate the investment in the subsidiary. What is the investment in the subsidiary, guys? Where do you see the investment in the subsidiary? Investment in high school, no?
But it says 0, doesn't it?
Who bought high school?
University.
Yep. And if this one buys this one, yes, this is an asset for this one because remember, you have shares. You have shares of the high school company, and that's an asset for you. Remember? But if somebody gives you money in order to operate or to buy shares from you, like in a public market, that enters as part of your equity. Remember, market capitalization. You have the market capitalization in here. So we have to eliminate this investment because, guys, imagine that you are adding up in here 70 and 80 because you are adding them up. So you are telling the investor that you have 80 more thousand, like 80,000 more than you have from equity and 70 more of investments. Do you see the trouble in there? So we have to eliminate the investment. And we will put a plus in 80,000. Do you have to touch the equity from the parent, which is the university? That's a question. Anybody?
Teacher, what I don't understand is why are parents being like in the game?
Why are what?
Yeah, like why are we considering the parents?
Who is the parent in this case, guys?
The client? Well, the one
No.
that pays?
The parent or the mommy, as you want to. It's commonly called the parent. I don't know why. Like, Patriarcado, I don't know why. So high school is the subsidiary. Okay. So what happens? Are we okay until that, Andrea?
Yes.
And why do we have to eliminate the investment in high school and the equity in the sorry, we have to eliminate the investment in high school from the parent and eliminate the equity section from the high school one? Because otherwise, imagine that in here you are making your capitalization worth 280,000. If you show it like this in just one in this step, and you're showing 70,000 more of investment, while you are the owner in one and the owner in the other.
Okay. So it's not like you're really investing in.
No,
Yeah. Okay. I think I get it.
it's like eliminating the borrowing. It's not like the borrowing, but like the
Yeah,
equity.
from
the
you to
equity.
you.
Exactly.
Okay.
Exactly, because at the end, now you are the owner of high school because you gave them that money.
Okay.
Okay. So we have to the second step is to eliminate current amount of the parents portion of the equity of. We have to determine the parents portion of equity of each subsidiary. What is the equity of the subsidiary? We just eliminated that part, okay? But what else do we have? The retained earnings. Those retained earnings, guys, how much of those retained earnings belong to the university?
$62,000.
52,000?
62,000.
How do you know?
The retained earnings?
Mm-hmm. No. The 62,000, it's what you reported as the university. That's
Yes.
the parents' earnings. And the first question was, do we have to touch the equity section from the parent? No, we don't. That is the amount that we provided for equity for the parent since the beginning of the parent, okay? But from the retained earnings perspective, the subsidiary generated post purchase, because remember that obviously if we had a pre-purchase equity or retained earnings, that's for the previous investors, okay? We have to separate those. Or in here, this is post-purchase or post-acquisition of the subsidiary. So from this 45,000 of retained earnings from the subsidiary, how much of those belongs to the parent?
Would it
Well,
be 80%?
Yeah, I was gonna say it bought 80%, the university, so like 33,000 something.
Agree. Yes, it is. So what we have to eliminate, guys, is the non-controlling percentage. You said that the parent has the right for the 80%, okay? But what if what happens to the other 20%? what we have to do is to debit the retained earnings times the 20%. Why the 20%, guys?
That part is still from the high school.
That's not part of the high school retained
Oh,
earnings.
is it because this is the column in which we eliminate what is not from the parents? So we are taking off the 2% that is not of the parent? Well, 20%.
Yes.
Okay.
Remember, this is the elimination process. Even the name of it's to eliminate, combine, eliminate. What are we eliminating? What I'm teaching you how do you do it on an accounting level, the goodwill and the non-controlling interest, which is like the hardest part to explain. Okay. And remember that the third part is to eliminate the intracompany or related parties transactions, something that we discussed the previous class, remember? Why? Because you can't sell to you like, oh, Enrique owns me $80,000. So let's calculate the non-controlling interest, and I will show it to you right in here so you can have the support. Okay. The question asks to measure non-controlling interest at its proportional share on the net assets of babies of the subsidiary, the high school. Okay, so what is the net asset of the high school? The non-controlling interest. Okay, guys, that's the net asset. And the amount of non-controlling interest is the 20%. Let me see that. Okay. So we can put the non-controlling part right in here.
Teacher, why is the 9,000 positive? Because I have a negative, but
Because
I
you
don't know
have
what-
it, you are eliminating the proportion of non-controlling interest.
Yeah, but what did you did like in Excel to make it positive?
I just put the minus 45,000 with a negative.
Okay,
Okay.
thank you.
Just give me 1 second, guys, because this is wrong. Perfect. So what is happening, guys, in here? Remember that what we are doing is to eliminate the part of the non-controlling interest, okay? So the difference between this and this, what do you think it is? Why would you think that it doesn't balance? Take a look at it. This adds up at 64,000 and this adds up at 70,000. What do you think it is?
Is it the part of the parent?
That's the what?
Like, is it the one, well, the part of the parent, like the other percentage? I don't know how to explain.
If I invested 70,000 and when I get to the fair value of this, it adds up at 64,000. So what's the difference that I paid compared to the value of the subsidiary?
Goodwill.
Oh, yeah.
Exactly. So let's see. The fair value of the investment, you have it in here, guys, 70,000, okay? So the non-controlling interest at the acquisition date is the equity okay. It's the non-controlling interest at the acquisition date, guys. Meaning that this was the value of the non-controlling interest at the acquisition date. The 80%, the 80,000 from the 80,000 that I invested, 20% of those are not mine. Remember, because I'm adding up to their equity what I invested. It means that 60,000 from those weren't given by my parent company. We had previously non-controlling interest of 60,000. Okay, guys.
Teacher, can you repeat that, please?
Okay. You see in the equity section, guys, from the subsidiary, you see 80,000. But that 80,000 includes 20% of non-controlling interest. Do you agree?
Yes.
So if I invested 70,000, which you are seeing it in here, okay? And there is from the equity section 80,000 in equity, from which I don't own 16,000. It means, guys, that if we deduct the equity proportion from the subsidiary, we will get to the goodwill section for the parent.
Okay.
It's just another way to explain to you how you get to the goodwill. How do we justify the disproportion between this value and the value of the investment? Okay, guys. let me give you another example, because imagine, guys, like if you had 16,000 that you had from the previous equity of the non-controlling interest of the subsidiary, your worth of the company should be 86,000. Do we agree until that? It should be like that. But we have only in the equity proportion 80,000. Why? Because we didn't capitalize that part, because maybe that's a premium for the investors, but we did pay for that. So in order to balance out our this balance, we have to recognize the 6,000 of difference. Am I explaining myself? I told you that the goodwill, it's a little bit like messy. I'm trying to make my best, guys.
Teacher, I
please-
do get it. Okay, I just have one question. What did you do below the 16,000? More below in the document? In,
Here?
yeah, one cell below 16,000. Oh, it's minus 80. Okay,
Yes, the equity proportion
okay.
in negative, because we have to subtract. It's the same example that I just gave you. Like, I invested this, and the non-controlling interest at the acquisition was 16,000. My equity should be 86,000, but my equity is 80,000. What is happening? You have to recognize goodwill because you paid above the fair value. Okay. So where are you gonna register that? Goodwill acquired in a business combination. And what happens? Everything balances out. Okay, until there, guys?
Yes.
Awesome, awesome.
I'm not, I don't know which formula you use on cell E52, the one with, you have,
E52.
because it is not the same that we used in the other ones. For example, in step 1, in which we added D40 and
Yes.
D50.
It's the same. Oh, sorry. You might be correct. Like that?
Yes. Oh. Okay, yeah, thanks.
But are you balanced?
No.
In which part?
I don't know, I have negative 25,000 on the E52 cell. Because I'm just grabbing that one cell.
Be careful because this is minus 25,000.
Yeah, yes.
Remember how did we get it? It's
By multiplying
the 80,000 and the 45,000, which gives you the total equity. I'm just
Yeah.
recognizing of subtracting from the equity, which part is not mine.
Yes,
Okay.
yes, yeah.
And from what I paid, I'm recognizing what I paid above the fair value.
Oh, okay.
Because as you might see, you're in here, you're watching 70,000.
Yes, yes. And
But
if you take
in the equity
six-
section, we have 80,000, and this 6,000, guys, just be very careful because you have to do an impairment test. What do you understand for impairment test? Okay, guys, don't sleep. Come on.
Teacher, you kind of froze. I don't know if it was my internet, but can you repeat it, please?
What do you understand as an impairment test? We have to do impairment test on an annual basis for this goodwill. It's by the guideline. And obviously it's for the auditing support of your figures. Okay. But you have to do an annual impairment test in order to identify that that this value, you don't have to modify it, because at the end it appears as an asset for you. Okay. What things move the goodwill losing value on the subsidiaries? That will decrease the part of the goodwill. Sorry, it will increase it.
So the question is, what will increase the value of the goodwill?
What
What
will,
other accounts?
yes, what will move, what will decrease the value of the goodwill? That's the impairment test. How can we, and in Spanish es pruebas de deterioro. Okay.
Would it be the non-current assets? Like all of them? Maybe, I don't know.
Can you repeat, please?
Yeah, that maybe, I mean, when you said deterioro, I think maybe it would be like the property, plant, and equipment.
It is like that. Instead of making it from a property, plant, and equipment, you do it for the company. And if it decreases the value, you have to decrease the value of your goodwill investment. Okay, that's an impairment test. Stay with that. And that you have to do it on an annual basis. Okay, until there, are we fine, guys? Hello. Come on, guys, we're almost finished.
Yes,
You're
I am
almost done with
processing.
your consolidation process. I told you it was a little bit messy. And I'm teaching you what I teach in 2-3 weeks. In just in one class. And I try to make it the easiest as possible. So high school, guys, high school, we have high school movements in here. Look, in the university part. And in here we have a payable from the high school section. So the last part is to offset and eliminate items to intragroup transactions. So who can tell me how can we eliminate those? How would I eliminate the subsidiary transactions, guys, the intra transactions, the intra-group transactions. In here, you have an account receivable. And in here, you have an account payable. Remember that if I have more assets, it's my company is bigger. In here, I'm inflating those assets and inflating also the liability. So how we subtract that part? Well, we just have to eliminate this, and that's it. Simple as that. Okay.
Teacher, sorry again, why did we eliminate them?
Can you borrow yourself, Andrea? In here, no, you're not borrowing yourself. Like you borrow to high school LTD, the university borrowed high school LTD, and here is the payable, and here is the receivable.
Okay. Ah, okay, okay.
You are eliminating your self borrowings. So guys, now we are prepared to consolidate. You do your consolidation process. You do the last column, the G. I give you 2 minutes.
Teacher, do we have to do it for each account or only for the totals?
For each account.
Okay.
Are you ready, guys? Thumbs up if you're ready, guys. We're almost done with a consolidation process. Just 1 hour. Are you done, guys? I'm done, huh?
I
Thumbs
think.
up. Okay. 1. Adriana, 2. Andrea, are you done? You have the mute. Your microphone muted.
I'm not that sure, but yeah.
We learn with our mistakes, not by getting it right, right? The loser said. So, no, guys, come on. Let's, and this is why I'm showing you this way. Super easy. The easiest thing I can figure out. And watch, it's just a matter of adding up everything. Adding up everything. But the way I taught you will make you guys, this is your consolidated balance. This is how the companies get it, okay? But the way I taught you will make something very important to be automatically done. And this is called the participation method. How do you get the participation method? Well, super difficult. Come on. You have retained earnings from university. These are the earnings from the university. We leave it as them because it's the parent. This is something that we obviously owe the owner of the university. But how much do we own from the high school retained earnings? How much is it mine for me as from the parent's perspective? How much of this retained earnings would you charge to the high school for being its parent?
80%.
80%. Let's do the math. And how much do you have in here? Voila. 90,000. And how much do we have in here? $90,000 and $98,000. Different ways, different methods, but the same result. And this is called participation method. Okay, which is just recognizing how much of the dividends from the or the earnings from the subsidiary company I own. So you would owe to the owner of the university this amount of retained earnings. Okay. Did you get the all the figures, guys? Because I need this as your evidence and support. This is a homework. Because this was the last topic for the capstone project. The capstone project will be very easy. It's just watching the CTA and you to do this process again by yourselves. It won't take you more than 1, maybe 2 hours if you're very slow. Okay, guys. This is wrong. This is wrong. Sorry about that. That was wrong. Mhm, mhm. Mhm. Okay. Mhm. What is happening? Oh, I see my mistake, guys. In here, I'm adding up this. And this is not this is the total of the equity, not the non-controlling. The non-controlling interest is the 25,000, guys. Not this is the total of the equity of each company. Eh? This is total equity. If you don't divide that, it won't give you the proper balance. Mhm, mhm. That's it. Did you saw what I did? Because I had a mistake in here, guys. In the exercise. This is total equity. And this is the non-controlling interest recognized. I just put it in the same total level. Yep.
Teacher, I think I did the same as you, like when I corrected it like you, but I got in the sum 387,000 instead of the 300 and
I don't know what is happening to you.
oh wait, in that cell, what did you do? In
I just put the thing is that I did this row. I put that row at this level. But this is the total row, not the non-controlling interest row. The non-controlling interest is what we recognized at the beginning. This 25,000. How did we get to those 25,000? Is from the total equity, how much it belongs to the non-controlling interest.
yes.
I mixed it with the total of the equity. section, okay? How did we get this 98,000? The retained earnings from the university with the participation method of the retained earnings from the subsidiary. So are this and this clear? The 45,000 negative? This 25,000 negative match this. The 88,000 matches this, and the goodwill matches with the goodwill proportion, which is in here. And that's how you consolidate. That's how with just an investment movement that can be done with a financing. Like how is going with Elon Musk and buying Twitter? He's asking borrowing to his colleague friend from the huge banks to borrow him money so he doesn't even have to have the money. And with that investment movement, he can grow from this 307,000 to 3,082,000. That's the value of showing you this. Like imagine to grow almost 33% of total assets in 1 year with just an investment decision. Obviously, guys, obviously from a strategy aspect, obviously it has to make sense from a strategic aspect. Maybe from Twitter, like I don't know how much it relates that Elon Musk buying Twitter relates to its other companies, but as you watched, Elon Musk has SpaceX that doesn't relate to Tesla, and PayPal didn't relate it to Tesla. So also there is a behavioral finance component that I can't tell you because like I can't tell you people purchasing Dogecoin. Why do they buy it? I don't know. That's a question for me also. You don't buy Dogecoin, please. Even Bitcoin is falling right now, huh? So guys, are you okay with this? Did everybody get the same results? Can you send it to me as part of your homework? So we can take a break and return to the introduction of Sarbanes-Oxley. Thumbs up if you finished with the same result, guys. Awesome, Joao.
Prof, just could you press on the tab of 382?
In this one?
No, the one at the bottom.
Mhm.
Thank you.
Awesome. Adriana. Come on, Adri. You're very serious. Very good, guys. Very good. Samantha, are you okay? Awesome. Marcelo, Arturo, both Arturos. How are you guys?
It still takes me a long time without a keyboard, so I try to do it and keep up, but when I fall behind, so I don't get lost, I go back to listen to it.
And you don't have another computer?
No.
What can I tell you, my friend? At least did you understand it?
Oh, yes, yes.
So how can you do it so you can deliver it to me?
Let's see. I think my roomie gets home at like 8 or something.
Okay. Well, so guys, let's take a break so we can start with Sarvanzo Clay, okay? See you in 15 minutes, 7:30. It's only the intro. We will see the most of it the next tomorrow.
Mister, where do we send it, to your email, or is it an activity in Brightspace?
No, email it to me. Awesome, guys. Thank you very much. This was the end of consolidation process. It was easy, no? Thank you very much, guys. See you in a bit. Hello, hello, guys. Are you there? Hello, hello. Guys.
Hello.
Yes.
Hi, Samantha. She's sleeping. So sorry, guys. My boss called. I had to take the call. It's not office hours, but it doesn't bother if it's not important. And it was important. Thank you guys. I will make it the shortest as possible so we can start. This is one of the topics that have granted me a lot of value in accordance to what companies need to be sufficiently, we can say, like, well managed. This is the most commonly accepted methodology in order to provide a company sufficient basis of control. So a shareholder doesn't, or it's not allowed to determine, for example, like what Steve Jobs purchased me my super jet for my company and make it broke because I end up the cash flow from the company. How do you imagine that we can establish controls to avoid these kind of situations, guys? What do you know about it? First of all. Guys, it's 15 minutes. Come on. Turn on your cameras. You're making me sleep. Hello, hello. You were almost in the bed, huh? Guys, imagine that you own a company, Apple company, and you want your super jet. Instead of paying suppliers, you decide to buy your jet. Are you allowed to do that in companies? If it's yours, if it's your company? How can we avoid these kind of situations? How would you avoid it?
Processes through its money flows, not just, I mean, you cannot just directly have money that comes in from sales or services come directly into the owners or shareholders' pockets. I mean, it has to go first through processes and then reap each person the benefits according to their holdings.
Okay, okay. Remember a lot of this theory that I will explain to you. And this is just the main section, like the theoretical part of the whole, okay? This is the general aspect. Once we figure out the general aspect, tomorrow we will see or watch a lot of examples, like the one that I taught you in the classroom. How would you manage to take care of your receivables? Please give me a control for the receivables. How would you control the receivables?
For the table, I don't remember the name of the table, but with the list of time and the number of clients
Customers.
owe you and having
Exactly. Nice. But learn the name, because otherwise you won't be able to search it in Google. So guys, let's watch this. All this theory starts with a lot of studies that determine that This is not the same risk as the financial exposure, guys. Don't mix it up. This is a different level of risk, or like another meaning of risk. This is from a control or processes perspective, okay? Like for an example, this is how you determine exposure in companies. You have vulnerability via your lack of controls, the hazard, the exposure, that it means that, for example, if you are a cashier, you have exposure to the cash. Okay, this is my exposure. And the hazard is situations that can, how can we say it? That can affect the company. The biggest and the most commonly the most common example is, imagine that you have cashiers, guys, in your companies. That's a very usual thing. The cashier has an exposure to the cash, right? The hazard, let's leave the hazard to the final. The vulnerability means that, what if you don't do the daily checks?
The accounts won't, they won't match what they're supposed to be in the system.
That's a risk. Exactly, that's a risk. That's what I'm trying to explain. But what if you don't have controls because you don't check daily, on a daily basis, your cash, and the cashier has an exposure on that cash? And what if, guys, what if you don't know, but that cashier has a wife that is sick and he desperately needs money because she needs to enter to the hospital? You tell me what would happen. What will happen in that situation?
You will take the money, maybe.
Yes, because you are allowing all these kind of situations. You are completing the risk triangle, the fraud triangle. You have vulnerability because of the lack of controls. You have a person with exposure, and you can generate risk situations that will affect your company. This great example started with Enron. Enron, as we have talked about Enron a thousand times. Enron did his super huge fraud, and this SEC, the Security Exchange Commission, determined that we needed to review the controls of companies. Okay, and as you might see right now, are you watching my screen, guys? In here, the risk triangle.
No.
Okay, let me show it again. Risk triangle, and this is public. Like always, I'm showing you the basis. What is Viva, guys? Anybody? What is Viva? Anybody, guys? Viva, no? You don't know it? The Viva is the newest stock exchange market in Mexico. What other stock exchange do we have? La Bolsa Mexicana de Valores. Okay. So what I'm showing you is what are the requisites of Viva to enter to this, to the so you can share, so you can sell shares of your company here. Have you seen this? How can you go public? I'm showing you right now. You can go public, first of all, with a corporate governance. So how do you have corporate governance? In here, they are telling you, you need to have an shareholders meeting or shareholders board, as you want to call it, administration's meeting also, an audit committee, and corporate practices committee with 3 years of operation of this corporate governance. And guys, the corporate governance is the fundamental aspect of what I'm showing you, which is Sarbanes-Oxley. It starts as a pyramid where the head part of the pyramid is, or the corporate governance is the corporate governance. Wait, it's the corporate governance committee. All of this, it's the head of the corporate governance, the strategic control, which establish the mission, the vision, the corporate objectives, strategic planning, policies, okay? Goals and key performance indicators, risk, the risk system, the audit committee, okay? Why am I showing you this, guys? Because the first component of control is to have a corporate governance on the head. What if the owner of the company likes to steal? Would you have control in lower sections of the company? The control starts at the top level from the C-suite and the CEO and the shareholders. That's why you shouldn't be doing business with everybody, because you don't know how ethical they are. You don't know how they conduct themselves, because the control starts at the top level always. Why? Because they establish the policies of how they are gonna control. So guys, how are you gonna control? This is the part that affects us the most, which is the management and control. I will show you how. This is the internal control methodology. And this is called COSO methodology, which is the methodology that COSO methodology, or the COSO framework, which is the basis of Sarbanes-Oxley. For Sarbanes-Oxley, you have guidelines. Okay, guys, I won't show you the guidelines. The important part is how to establish a control environment, how to assess the risk, how are we gonna establish the control activities, and how are we gonna make our IT department help us in these control activities with an ERP, with a control system, with a treasury system, and how are we monitor these activities? Maybe with an internal audit, okay? Please, this is a definition, COSO framework. This is for sure gonna be in the exam. COSO framework is part of the Sarbanes-Oxley. And how are we gonna get it practical for us, guys? This is the last part, and this is the last message, okay? Where is my control matrix? Give me 1 second. I had it over here. Hmm. Okay, it's here, but it's very. Okay. Where is it? Now I lost everything. So, okay. So guys, the first thing is how to establish an internal environment. Internal environment. How do you establish the internal environment? It must have these components. If you want to have corporate governance, it must have these components.
Teacher, are you sharing screen?
Yes. Did you watch the COSO framework, guys?
No,
Come on.
we're not seeing your screen.
Come on, tell me.
It said you were sharing and you stopped. I thought you knew and you were doing something.
So sorry, so sorry. Did you watch this from Viva?
Yes.
Okay, perfect. And did you saw this triangle of corporate governance?
Yes.
So how do we establish from the COSO framework the internal environment, which is the first thing, guys? The first thing. We must establish this corporate governance. And let me close this corporate governance. Can we establish this corporate governance in all the companies? No, it depends on the size. Obviously, imagine that you need a audit committee. Not all the small companies are able to pay that. But it doesn't mean as Sarbanes-Oxley is not requested by Viva. As you are watching it, it only says you need corporate governance. Sarbanes-Oxley is requested by the SEC in the US. Okay, but it doesn't mean that you can't learn or that it is not beneficial to your companies. So the first thing is that to establish a controlled environment. And how do you establish a controlled environment depends totally on the owners of the company. And then in the administration board. The thing is that the administration board and the shareholders meeting must be ethical. They must conduct themselves accordingly on an ethical way. They must establish the policies in order to control and prevent risk, as just mentioned with the cashier. And that can be done with the OXO from the corner. The control to review the cashier can be established by the owner of the OXO. And that's what I want to transmit to you. How are we going to establish and identify the risk from your companies, and what are controls that are able to control or assess or mitigate that risk? So when we establish that the environment, that the head is ethical and wants to conduct on a business way, and it's a professional business guy, we need to assess and the risk. How we are assessing the risk depending on the events. We must identify the events. For example, I gave you the example of the receivables. That it's an event. You will have customers which you grant them credit. That's an event. So you have to assess the risk of that. Please tell me the risk of giving credit to your customers.
that maybe they won't pay you back.
Perfect. Give me another.
That they pay you later than you agree, than the day that you agree.
Okay, one is late payment and the other is that they don't pay. Okay, two risks. What other risks? You tell me.
Maybe because of that, you have liquidity issues.
You can have liquidity issues. Nice. That's a risk. What else is, guys?
Inflation,
How that can be a risk in the receivables component?
not really sure.
So
It will be
it's
worth
not a risk.
different amount.
Defend your thesis, Arturo. What, Marcelo?
I'll defend Arturo. It will be worth a different amount. It's the cambiario.
The exchange risk is another thing. Exchange risk. Yes, you have exchange risk, exchange risk exposure. Look, you identify 4 elements of risk in just one thing. So guys, how are we gonna prevent the risk of not being paid? You establish the controls. Right now, we are the CEOs. We are the administration board.
You can send reminders or notices
For whom?
for the ones that they are going to pay you, like the.
And what if he
payment-
doesn't pay from the notice?
Mm,
Then you have the other steps, the no more credit, and next time he'll pay upfront. And then the last one is the legal action.
And what if we are the administrators, would we have shareholders above us? With what Marcelo just said and with what Samantha just said, what would happen if a shareholder tells me, hey, this customer haven't paid us. Why is he in the balance since the previous year? What did you do? I noticed him 2 times. I stopped its credit and we entered to a prepayment operation. And when he didn't pay, I got involved the legal department, and he has a lawsuit. What would the shareholder say to that? What else can you do? Go to the door of that guy and make him pay, or what? That's what we need to do. That's what we will review tomorrow, okay? Start assessing the risk of your cash accounts, your receivables, your payables, the type of frauds that you can get from property, plant, and equipment. What are the risks from property, plant, and equipment, guys? Tell me one.
Depreciation,
How can you have risk from depreciation?
the building or whatever it is loses its quality. I don't know, like for time, and also it could be for any unforeseen event, for example.
Remember that the depreciation from an accounting perspective is an estimate. But as you are telling, Arturo, as you are telling, we can estimate that the life usage of the building is 20 years. But what if the building in that section or in that city, you have hurricanes and tornadoes and a lot of vandalism, and the life usage of that building is 10 years, the real life usage. So we have risk of misvaluation of the or undervaluation of the depreciation. How you will control that? We can do an annual review of the building to test that the depreciation goes accordingly to the life usage that we are using in our estimations. That could be a control. Does it make sense to you guys? Okay. So the same with accounts payables. In all the accounts, we can determine tomorrow the biggest fraud, the biggest risk on each account. And this all translates in that the accounting information that you will provide to your shareholders comes with the little or with non-errors because of frauds. Or imagine, guys, what is the risk of the accountant having control of the bank? Just
That
to
he
finish.
could steal the money.
We spoke about that. That he steals the money, but stealing the money, it's always a risk. But what's the risk of having the accountant paying from the bank?
That he can create an account and like, yeah. And in the registers.
He can alter the registers and pay. Maybe he puts it as payroll and it's his payroll, but you don't see it because it's in a payroll account, whatever. Those are the risks that we have to assess, guys. And I will teach you tomorrow. But that's the whole perspective. That's the general perspective. Now you understand it. Okay? I won't teach you how to the proper guidelines of Sarbanes-Oxley, because at the end is the same as I'm telling you, but obviously at huge companies levels. Okay? So thank you, guys. See you tomorrow. Tomorrow, oh yeah. One thing. Tomorrow is our last class, right? We don't have an assigned classroom, but from 4 to 6, right? We don't have an assigned classroom, but why don't we see each other on the building? And
Yes,
we
I
can
think
go
we
into
need,
the co-working and something like that, because I want to see you. It's our last day of classes. Okay? So we can see each other on tomorrow.
Tomorrow at 4, right?
Tomorrow at 4, from 4 to 6 p.m. Okay?
Okay.
Last class. This is the final aspect. It's Sarbanes-Oxley, which is the last part of the syllabus. Okay? Thank you very much, guys, and see you tomorrow.
See you
Thanks,
tomorrow.
teacher.
Don't forget to
Thank you,
send me
Prof.
the
See you.
consolidation exercise.
Okay,
Bye.
Bye-bye.
Nice.
bye.
Oh, mister, I was with Flora and she wanted to say hi, but you never, but there was never a chance because we were all the time in class. But she sends her regards.
Who? With who?
Florencia.
Ah, nice. Nice. Say hi
Yeah.
to her.
Yes, I will tell her. Bye, mister. Have a good night.
Bye-bye. Bye-bye, Arturo.